Hello again. This is Saul Hicks, and I'm just so excited to be speaking to all of you because of my vast experience. And I can speak to you from confidence because the things that I'm saying, these are things that I have practiced, I have done, and now I have the experience to share it because it's very important for me to continue to have long life. And I hope that if you apply some of the principles that I have applied at 82 years old, that you would say, Mr. Solomon, I really thank you for that advice because some your experience helps when you're willing to share and being transparent. The question oftentimes, what is the difference between whole life, variable life, index products? Why don't I invest in term insurance? And perhaps I can take what I'm putting in for the universal life policy or whole life policy, and I can put that into the market. I believe I can yield a better return. Perhaps you can. But a couple of things you have to keep in mind. One, discipline. Number two, if you're taking the difference that you are putting into any type of an investment, it might be a mutual fund, it might be stocks, but a portion of your gains that you're making off of that generate a 1099, which simply means have to give something back in income taxes. If you're buying a life insurance policy, the growth of the cash value that's inside of your policy is sheltered. So you're able to keep all of the growth, not generate a 1099. And it's hundreds and thousands of people that's pooling their assets that's being managed by an account manager. It's well diversified. So it's not one product that you're putting in one investment. It's spread it out so you're minimizing the risk. That is whole life. That is index products. So we shift over. Well, what about the term insurance? You can still get the same amount of protection. And I recommend that for younger people that may be on a small budget, that they want to protect for protection for their family. So you buy the term insurance, but it has a lifespan, whether it's a 10-year term, 15, 20, 25, 30-year term. You're renting the insurance. And if you die within that term period, it pays the beneficiary the full amount of that death benefit. But should you have long life, you could outlive the term. It's okay if you have mortgage you're trying to preserve and protect, it is fine. Secondly, what it does, it allows you to convert to a permanent plan without any proof of insurability. Because we all at some point become uninsurable. You have the money, but the risk is too great. The insurance company will not offer you coverage. The term allows you to convert without any proof of insurability. And you insure your human life value. You are doing a need analysis that can simply say, well, what happens if I pass away too soon, if I die too soon? Secondly, there are policies today that you can add a rider that covers your quality of life. Because, there are many things on our journey that we call life. A lot of things can interrupt that at any age: heart attack, stroke, cancer, long term care, terminal illness. So you can add a rider to your life insurance policy. It's kind of lacking to today you can't really, most cars, you can't get a real tire. I call it a donut tire. And it would have you to drive to safety to maybe a service station to get a real tire, as long as you don't exceed maybe 50 miles an hour and you're going maybe 50 miles you're traveling to. So it served the purpose. It takes you out of the danger zone. That's a rider. So if I have that on my insurance policy, whether it's a term policy, whether it's universal life, whether it's index, I have that as a rider. And you hope that none of those things happen: heart attack, stroke, cancer, terminal illness, long term care. You hope that it doesn't happen. It's still a life insurance and it still covers your income replacement for your family. You can do that with some companies with term, some companies with whole life, because they understand that before you pass away, your quality of life can be impacted. And I don't think anyone want to be and relying on others to take care of them. This is where careful planning takes place. And it's that one pocket doesn't fit all. It all depends upon what your needs are, what you're trying to preserve, and what you're trying to protect.